You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always. Welcome to episode 303, and we have a very special guest in the studio. It's Tim Reardon, Chief Economist at the HIA. He's flown in for a couple of chats. He's been whizzed around the country by his minders, we'll call them. And his very special minder today is Mike McGowan, Executive Director of the HIA. He's actually sitting here, right here. Say hi, Mike.
Hi, Trent.
In the background there. And Tim's on the mic. Thanks for coming in, mate.
Thanks for having me anytime.
We have a big conversation to be had today, and I guess I want the theme to be context. We've had crazy numbers going through Perth's property market over the last few years. To give everyone an update, we're at 3,700 properties on the market. 5 years ago was 17,000. A balanced market is 13,000. We're transacting at 870 properties this week. We've been between 800 and 1,000 for 5 years now. The mining boom was 800. So we've been sitting above mining boom demand for 5 years now. Median days on market sitting around a week. It used to be 2 months before COVID. Everything is as white hot, off the charts, record highs as it's ever been. And we're constantly having conversations in the industry about how do we fix this supply problem? How do we figure out how to build enough homes for the people that came in? 90,000 came in last year. They need about 40,000 homes. We built 16,000. So we'll have a chat about all these things today, especially given that you're at the HIA, but also if we can start with some context around how Perth's economy is going, how Perth's supply situation is going compared to the rest of the country. Because one thing I've noticed recently is a couple of things. One, we're hearing a lot of negative news nationally about recession, about GDP per capita going down, everyone finding it really hard, cost of living on a national basis. How does that obviously compare to Western Australia specifically? And also, mining industry, we're at $90, we used to be at 150, all those sort of questions. Context is very important.
Well, so let's start with WA economy is growing at a pace that is more than any other two states combined. WA zigs, the rest of the country zags. You're always out of cycle. And it's really important to always have a contrarian at the table, and WA is our contrarian. On the population side of things, national economy is still growing despite all the best efforts of every bit of regulatory intervention and the rise in interest rates, and it's likely to continue to grow as well. The Australian economy, incredibly robust through every cycle, 28 years of continuous economic growth. It took a very conscious effort by the federal government to cause that one recession we had during the pandemic, and that wasn't a real recession. It's not all Pollyanna stories anymore, however. That household story and what's happening to Australian households, the inequity in the way in which this burden is borne, we're going to see play out at the next federal election. And it is a narrow cohort of Australians that are bearing a very high cost for what's happened. They are renters. They are people particularly under the age of 40 and definitely under the age of 30. And on the other side of the equation, we have a group of people that are being rewarded, which is those who own multiple homes and those over particularly the age of 60 that are being rewarded in this cycle. And so the inequity of housing, that is a topic that's playing out politically, and we can see it in every state and federal election. It is the number one issue at the next federal election and the number three, whether it's the state of the economy or whether it is cost of living or housing, or all three of them housing driven. WA, again, stepping out of cycle with the rest of the country.
And we notice that all the time in WA. We are contrarian. I think we like to be contrarian in some way. It sets us apart. And we see it often in the way that monetary policy affects us. When we need help, we seem to be stuck with high interest rates. When we probably could do with a bit of cooling down, we get interest rates dropping. And it feels like we're on the precipice of another incendiary, inflationary cycle coming in, where we're at white hot in state demand, in amount of cash sitting in WA, in our property market as well. And sometime soon, it seems likely we're about to get another sugar hit with interest rates dropping. None of us complaining, but isn't it interesting how we seem to be called a boom and bust state because of the mining industry? But really, when I think back in my lifetime, most of the times our market has boomed or busted. It's really been helped along the way by counter-cyclical interest rates with regards to where we are at in Western Australia.
Yep. So 2015, 2017 cycle is a great example of that. Apartment construction, Sydney, Melbourne, Brisbane was booming. APRA and ASIC were concerned about an oversupply of housing, which is a deeply remarkable scenario now to propose that they were talking about zombie apartments being built in Sydney, Melbourne, Brisbane that were going to be unoccupied. If only they had allowed that market to continue to go, we would not have such a deep problem that we have at the moment. But yes, they brought in the speed limit to growth and restrictions on investor-only lending, which slowed down home building in the East Coast and really took what was happening here in WA to, we'll say, decimated levels of home building right prior to the pandemic. Your market that should be building 25,000 homes per year got down to building only 9,000 homes per year. And the recovery that we're seeing at the moment is a lingering effect for that. But if we start with that macro story of the global economy and what's happening there, I think what we're going to see on an interest rate front and globally is the US, yes, they cut interest rates over the course of the next 12 months or so, and quite significantly, and they cut more significantly than we do it because they increase more significantly than we do because 100% of their mortgages issued are 30-year fixed loans, as opposed to our market where almost exclusively variable loans. And so the differential there between how much they have to change their cash rate in order to have an impact on the economy is significantly larger. So we see US cut multiple times.
Canada as well, England, Europe, New
Zealand's already started, all those scenarios. And so then what that does, we see an appreciation in the Australian dollar, which is bad for iron ore, coal.
Bad for us in WA.
That's right. But what it does do is it slows down inflationary pressure in Australia because imported product is cheaper. Therefore, that pressure comes off the CPI sometime early to mid next year. We see the first cut to the cash rate. Now, as you said before, it's going to see a drive in demand for housing and a return of particularly owner-occupiers back into the market. We get another little cycle of house price growth and a pickup further in home building activity.
People artificially richer.
That's
second
right.
That happens, right? You make $100,000 a year. Let's say your affordability right now is a loan of $450,000. Overnight, now it's $500,000.
But structurally, we're going to see interest rates higher over the course of the rest of the decade than what we saw prior to the pandemic. And that's because of the level of particularly federal government expenditure. That is inflationary. No amount of $200 electricity rebates offset that. It's not all the current government's doing. It is a legacy coming through from the stimulus measures that were spent during the pandemic as well.
There's too much cash in the economy because of the tens of billions of dollars that were spent to help us, to save us in COVID. Is that the easiest way to explain
That's exactly right. And so structurally, we do see interest rates high. Yes, there's short-term cyclical cuts here and there, but we're not going through the cycle that with the boom-bust cycle that we've seen through the pandemic. And then when we look at global resources, we can see that China has spent most of the last decade, or if not 2 decades, trying to protect itself from resources prices in Australia. And they've done that by investing in iron ore in Latin America, tin and copper and zinc in other Southeast Asian countries, large investments in Africa as well. And finally, those investments are coming through. The volume of aluminium smelting that the Chinese have built exceeds the global capacity that existed 20 years ago. The volume of tin refinery that they have invested in the past 5 years in Indonesia exceeds the global capacity 20 years ago. There's an enormous volume of investment in resources capacity outside of Australia. So what's not likely to happen in Australia over the course of the next decade is that we see that cycle of resources investment that caused the mining boom in Western Australia, particularly in that 2014-15 cycle. What we're looking at now is much more of that continuity phase of production where the long-term contracts for exporting coal, iron ore, whichever resource you're looking at are in place. There are changes in price, but for those long-term contracts, they're largely not affected. And as those mines get older, their employment of labour increases because their maintenance and repair continues to grow the older the mines get. At some point, they do become marginal, but that is not something that we're seeing here for the next couple of decades. So from a WA perspective, you're the boom-bust roller coaster economy, but I'm not sure that the next decade looks like that. And then when we add housing to that, even if mining slows down, home building in WA without migration, you will be building homes at capacity for another 3, if not 5 years in order to cope or catch up with the pent-up demand that exists here.
That's the best way to I guess, characterise some of the answers that the questions are seeking from me at the moment is, Trent, what if the mining boom slows down, iron ore price, these sort of questions that you see come in. Well, how does that affect the housing market? And really, that is the answer that needs to be given is, even if population growth came to a halt tomorrow, we still have 5 years of 10 to 15,000 house deficits that we still have to catch up on.
Yeah. So at the moment, with given population growth in WA, you should be building probably 30 to 33,000 homes per year, and you're starting 15 or 16,000. We have this debate internally of just how many homes can WA build given its current labour constraints. So
we've never built anywhere near that amount.
Yeah. And so it's going to take a long time to catch up. The capacity constraints here, particularly around labour, and what you're not going to get as you did during that 2014-15 cycle. We have to remember in that phase, home building in Sydney and Melbourne was at one of its lowest over the past 20 years in that post-GFC down trough. And so WA was drawing workers out of East Coast. It was drawing workers particularly from Ireland. And you can still go to Scarborough markets on a Thursday night and see the Shamrock jersey wandering around everywhere.
Yeah. New Zealand?
New Zealand might be an exception in this, but there is no other part of the country that is pushing workers out, possibly an exception of Western Sydney, but they'll get absorbed between Newcastle and Wollongong or just outside those areas anyway. But there's really nowhere else in the country, no other industry sector that's pushing workers out at the moment.
What do you mean pushing them out?
So there isn't a slowdown in home building anywhere in the country other than Western Sydney that is large enough to see an abundance of skilled trades.
Okay.
So every builder is holding their skilled tradespeople. It's a conversation we routinely have with the federal government, and they ask the question of just how much labour transfer is there between residential home building and the mining sector? And my answer is none. We don't need a transfer of labour between the two industries to see them significantly affected by prices. And my example is the Halloween storm damage in the southeast corner of Queensland in 2018. We saw that storm damage that saw a 30% increase in the price of roof plumbers in Queensland 2 weeks after the event. It took 2 weeks for that 30% increase in roof plumbers in Queensland to flow through to a 30% increase in the price of roof plumbers in Melbourne. Not a single roof plumber moved from Melbourne to the southeast corner of Queensland, but they had to match the rates of pay. And likewise here in WA, it's not that we're losing our skilled tradespeople to the mining sector, it is the threat of losing them to the mining sector and what they could earn, and therefore the building industry has to maintain price parity with the mining sector. So that's going to keep us constrained in terms of labour for quite some time.
Well, and obviously cost of construction as well. One thing I think there's not a question in WA anymore, even though early days it was a question, is, hey, when will the price of construction come down? That ain't happening.
Yeah.
At the very least, the question now is just when will it settle? And it seems like it's settling. It has settled. We're in low single-digit cost growth numbers this year for construction, whereas we know since COVID we're up about 50% on the cost to build a home.
Yeah, so 1.1% increase in material prices over the past 12 months, so we're back to normal.
Sustainable.
Yeah.
Quotable.
Since the 1970s, there's been 4 occasions where material price growth was at 0% or smaller, and it was just 4 quarters in that 40-year cycle. So we don't have material price declines. They're now stable. There are some materials that have fallen significantly. Timber in particular, went up nearly 100% during the pandemic. It's fallen back quite significantly. We've got other ones, glass, steel, aluminium, all of which are continuing to go up in price because of the cost of energy. And so the two of them are offsetting, but we're back to stable prices. We look at labour. Labour's relatively more stable. It's the shortage has eased significantly. There is still an acute shortage of skilled trades. We can talk about access to overseas skilled migration, but
let's please segue into it if we can, Tim.
Yeah.
There seems to still be a disconnect in our population, I guess, between what I suggest is the need for importing skilled labour to fix this problem, because we don't seem to have the people internally to do that, and the anti-immigration nationalist view of, well, why would we import another person to help build a house when they're going to take a house from us in the first place? The answer obviously is the multiplier effect that comes from that person, right?
Yeah, that's very true. We have this chicken and egg problem everywhere in the country, which is how do we get more workers in to build the apartments when we don't have houses for those workers? And that's a real challenge for Perth. And talking to high-rise apartment builders nationally, that is their constraint. They look at rental vacancies here in Perth and go, there's no way we're moving a labour force to Perth to build apartments. There's nowhere to house them. So that is a structural problem that is going to take many years to resolve. And even when we start building a sufficient volume of apartments, doubling back to what we were building a decade ago, it's going to take 3 years from commencement to completion.
That's right.
So it's and then in that cycle of building, just as we saw in that 2015, it in itself creates that cycle of economic activity that we need. So there's a return on overseas migration. But
we don't even control that though, Tim. That's the frustrating part, is we probably need, 15, 20,000 migrants today that have skills. because we have so many people that have come in that need the homes who none of them had skills. We're importing all these people who don't know how to build a home when really we should have been importing people that can build the home for everyone else in the first place, right? Get those people in first to build the houses for the people that want to come with the other skills that we need in WA. We've been doing it the opposite. The problem is we're not in control of that. The federal government's in control of that.
I'm not sure now that they are particularly in control of that, because once you begin that cycle of high migration, it's very hard to stop. 200, 220 would be a typical net overseas migration number going back a decade ago. We got down to 175. We hit 550 last year.
550,000
550,000 net overseas migration. And so the government has forecast to get down to, I think it's 300 and then 250 and then back down to around about 200, 220 over the course of the next 3 to 4 years.
But who comes in those numbers
so that
is controlled by visas, right?
That's right. And so there is no way, it was extremely difficult to slow that 550 number down to 350,000 given what that clocks up in terms of other arrivals, whether it's family reunions or partner arrangements, all of those other visa categories. It is very difficult to slow that number down. So my expectation is that we're going to see it closer to 500,000 than 300,000 in this fin year.
And we're getting more than our fair share because of the economic activity happening in WA.
Yeah, more than your fair share. So the population projections in WA have you, I think, close to 100,000 people more here now had the pandemic not have occurred. And that's rather unique. Southeast corner of Queensland is in a similar boat, but Sydney and Melbourne are both now at around about the population they would have been had the pandemic not occurred. But WA, southeast corner of Queensland, have gained more than their fair share of those migrants.
Given we're on the topic of foreign people coming to Western Australia, one thing from an economics point of view, I don't think the industry has been able to get through to our treasurer yet, and I understand it's a political hotcake in the first place, is the foreign buyers surcharge issue. In 2017, Ben White and all of his wisdom decided that, hey, we're not getting enough cash through. We were in deficit at that point in time in WA. Tough times back in 2017. How about we try and raise an extra $50 million through charging international buyers 7% tax on buying a property in WA. The reality is that not only are those people now not buying anymore because they go, stuff that I'm not paying 7% on top of the stamp duties, we're at 12% now. They're also not getting the stamp duty now. They're not getting the apartments built. And most critically, I would say we're at least 5,000 apartments down on what we would have been if we didn't introduce that foreign buyer surcharge. That's pretty mental when you think about the amount of people who are looking for a rental property right now.
It's probably the worst own goal of any public policy decision in relation to housing. It's difficult to make the calculations, but it's probably revenue negative. It's probably raising less revenue as a consequence of that than had they have not imposed it, because there is the stamp duty, there is the land tax,
GST,
there is the GST, there is payroll, there is all of the withholding taxes that go along with it.
It's just negative economic activity.
It's deeply remarkable that we're taxing the one thing that we really, really want, which is investment in housing.
Minister Saffioti and Minister Kerry, they always speak about we're pulling every lever to help the housing shortage. This is a lever that they can pull that I actually think will make them more money, that will assist with a major cultural issue we have in Western Australia, and that is an aversion to owning apartments. I think we've passed that in the East Coast. It's nearly become parity, right? Yeah. But in WA, you might be able to have some context here. West Australians still see owning or living in an apartment as a compromise, as, I couldn't afford the house, for example, or I can't live in the house anymore because of my means. Now, because of that, and in addition to this, the structural cost issues of apartments being developed in the first place, we have far less people who would actually want to buy an apartment, especially off the plan, given they don't trust the builder, the defects issues around the country. It's currently very hard to incentivize or get people to buy the idea of an apartment that may or may not be real in 5 years' time in Western Australia right now. The people who don't really have that issue, historically in Western Australia, have been international investors, people who 97% of them don't ever live in Australia, 70% of them buy apartments, and therefore most of these end up becoming rental properties that we desperately need right now. They generally are the ballast financially of getting an apartment building off the ground. They're the first 50% that will get an apartment development moving financially, so that the next 50%, when maybe it's half built, can get sold to those downsizers in WA who go, I can see that's actually happening. I'll buy one now. Without the first buyers, the building never gets off the ground in the first place.
Yeah, and that's the problem we have at the moment. Very low volume of commencements, partly due to shortage of labour, other challenges, but that acute shortage of investment from institutions. If you want to look at a market the inverse of Perth, then Canberra, 70% of new homes in Canberra are apartments.
Wow.
Yeah, and I remember seeing people complaining that these apartment complexes were going to be phantom apartments and no one's going to live in them, and every single one of them is occupied. And Canberra now has the highest rental vacancy in the country, which is still acutely short at about 2.2%. But if you build a bucket load of apartments along a train line, they will be occupied anywhere in the country, and it is a solution to that housing problem and has to be a part of that.
Michael sent me some data a couple of weeks ago on construction numbers, and one thing that stood out to me was that although our state government policy says we want 47% of our new construction to be infill, less than 10% currently is infill. The rest is house and land.
Right.
You don't see that anywhere else in the country, do you?
No. So Sydney is almost a 50-50 mix. Apartments have fallen off. Melbourne, likewise, 50-50 mix. Queensland, between now and the Olympics, is going to have to challenge the ACT, or particularly the southeast corner. Right? That's right. Yeah. And if we go back, it's hidden in the data, but if you can see it in that 2015-16 cycle, it was the apartments that they were building on the Gold Coast for the Commonwealth Games were part of that boom. And people forget about that, and how quickly all the concern that we're building these apartments that weren't going to be occupied by anyone. One of the things we haven't mentioned is the macroprudential restrictions, ASIC and APRA. Their fear that somehow we're oversupplying the housing market and that was going to cause a financial contagion event that warranted them to continually wind up those macroprudential restrictions. So when we're talking about interest rates, I think one of the bigger gains in the next 12 months isn't that cut to the cash rate, but a recalibration of what we're seeing with the HEM, other macroprudential restrictions. There is still that 3% buffer that's in place.
That's right.
The UK got rid of that more than 2 years ago. I don't know of any other developed economy in the world that's retained that emergency macroprudential restriction yet. Here
Especially
in Australia,
when there's a view that the next move is down now.
Yeah. And in Australia too, where we have spent a decade of making it increasingly more expensive for banks to lend to first-home buyers, the collateral that banks have to hold if they are to lend to a first-home buyer.
They have to pass to us, right?
That's right. And so it's more expensive for banks to lend to first-home buyers. And so increasingly, there is less and less competition amongst banks to lend to them. And that is part of the reason. So if there is an easing in those macroprudential restrictions, and we have to keep in mind that the purpose of those restrictions is to stop or prevent systemic risk within lending.
Stop banks going broke. That's
right, and a very good reason. The 90s weren't that long ago for some of us, and we remember state banks in different parts of the country. So it is important. We have, after a recession and the pandemic, mortgage delinquency at 1.4%, astoundingly close to zero.
And Perth is the lowest in the country.
Yeah, because you earn more than anyone else in the country and your houses are relatively more affordable. But even if there is mortgage delinquency, those people are still selling capital positive. So it is only a narrow cohort. You'd have to see house prices declining in a substantial way, which would require unemployment to be not just 5%, but more likely 7% to get into a scenario where we're seeing some structural decline in house prices and sustained over a period of time and offsetting the deposit that was placed and offsetting mortgage insurance. It's a scenario that's very difficult to conceive. Why we have wound those restrictions up, given the shock, was the GFC. And at the peak of the GFC, delinquency here rose to 1.6% compared to it started that cycle in the US at 5%. Just this ever-ending pursuit of zero mortgage delinquency is imposing a really high cost on first-home buyers.
Yeah, I agree. And it's really insightful that you mention the prudential side of things, because I think everyone obviously is focusing on Michelle Bullock, waiting and wondering when is she going to drop it. Well, she can't drop it because this year, because she said she's not going to, and there's no way that I think she's going to have egg on her face this year, even though the whole market is betting real money that she will. But I struggle to see personally how she's going to allow that egg to be on her face until early next year, the first meeting next year. But as I was going to, in addition to that, the prudential measures that you're talking about, you're right, they're highly restrictive and they don't need to be.
No.
And definitely the sum of the cash rate dropping and the noose around banks' necks starting to loosen a little bit should help not only the first home buyer, but what I think is really the key here, the developer. For people who aren't a developer or certainly aren't an institutional developer, getting finance for your apartment building is really hard and really expensive and takes a long time.
Yeah, particularly a 3-year build horizon, 2 years to sell it up front. It's a lot of cost of carry. On the macroprudential front, APRA and ASIC really need to be held accountable for what they have done to lending. The constraint on competition that they have imposed on banks takes us back to something more like the 1980s, where the government determined who could have a loan and who couldn't. So we're back to that scenario, particularly for first-home buyers. Whether the solution is a Campbell-style inquiry like we saw in the 1980s, or whether the solution is to impose a board of governance over APRA and ASIC's macroprudential restrictions like we have with the Reserve Bank, and or a target for mortgage delinquency of, say, 2 to 3%, because we recognise that some level of inflation, that 2 to 3% band, is positive for a growing economy, and we tolerate a level of unemployment as a consequence of that. So perhaps we need similar measures like that to ensure that there is the oversight of those two organisations as they go about their path of ever-increasing activity to remove risk from what should be a risk liability borne by the banks.
Sort of looks like bureaucracy in a way. It's justifying positions. And I think you're right. There needs to be an honest conversation about a tolerable level of delinquency, a banding there of going, look, we're not looking for 0%. We understand that some people in this market are going to make bad decisions and things change in their life, right?
Sudden loss of employment and divorce are the two main causes of delinquency.
Banks don't manage that.
No.
And they're not responsible for that either.
As economists, it's very difficult for us to address divorce.
Exactly right. And the outcomes of that generally starts with the home and starts with who's paying the mortgage this month, because it ain't me. Often that has nothing to do with whether you've got money in the bank. It's more about a domestic argument rather than an ability to pay in the first place. So I think it's important for us to drill down in Western Australia on what that medium-term view of solving these problems looks like and the outcome it has for Western Australia. What we've seen recently is our stock on market get down to record low levels every month, but what looks like a bottoming out at about 3,300 properties on the market right now, of which 500 is vacant land. So we're going to be building on those at some point in time. 3,700 is where we sit right now going into spring. Spring selling season, a lot of people start bringing their properties back to market. But it's nowhere near the balanced market of 13,000 properties we need. I assume in order to be able to get back to that point, one or both of these things need to happen. Either we see far less people demanding property, which is essentially far less people coming to WA to do that, and or over and above levels of new supply come to the market that could be sold. Now, we've spoken about how we don't expect immigration to be dropping markedly anytime soon. And if it does drop, it will still be well above long-range averages for years to come. So they all need houses, and therefore demand most likely continue to stay above the mining boom's numbers for years to come. So the supply side has to be the answer in terms of getting stock back up to a balanced level where prices aren't continuing to grow. You're suggesting it's 33,000 a year. I would agree it's at least that. We're at 16,000. We've got the executive director of HIA in the room as well. What are the solutions that the HIA is bringing to the table as well on how we actually in Western Australia get from 16,000 to 20,000 next year, 25,000 by some year this decade, that year build the houses we needed that year, let alone the deficit we built up the last 5 years and probably for the next few years to go? How do we do it?
Well, it'd be nice to blame the government for all the problems, but unfortunately, this is a problem that has been caused by time, and only one thing will solve it, and that is time. So WA is different from what's happening in Sydney and Melbourne. Sydney, a new house and land package is around 1.5 million.
Yeah, we're complaining about 850 right now.
There we go. Yeah, and so the big constraint here, of course, is labour shortage. That's going to take time, whether it is training, whether it is labour moving from interstate, whether it's labour that's imported. Regardless, it is going to take time to train. It's going to take time to build that capacity within the industry to build the homes. Yes, stamp duty concessions, reduction in tax, easing of planning regimes, all those things will assist. But for WA, the problem is quite different from the rest of the country, and that is it is just about labour.
Just people.
That's it.
And I struggle to understand why we aren't attracting those people.
If you look at the interstate migration numbers, WA is significantly net positive. And interstate migration, if we have just one piece of data, that would be the one to track. And so we know they're coming here for jobs. Interstate migration is more likely to look for detached, so therefore you have more of an employment multiplier on that side of things.
So really it's just a case of patience. And in that time, there really only is one way that on the whole property prices will continue to go. Yeah. And I speak to this as plainly as I can to everyone. In order to see prices drop, you must be in an environment where supply growth is stronger than demand growth, or supply is just larger than demand at the time. And I just cannot fathom a situation, I'm trying to, just to play devil's advocate here, where that happens in the short to medium term future in the face of a small but slightly vocal number of people suggesting, well, we've had a couple of years, it's time to drop. That doesn't just arbitrarily happen, Tim, does it? It only happens when the fundamentals allow it to.
Yeah, even if you had unemployment at 7.5%, you would need something more significant to occur to get that supply and demand equation to have a sustained decline in house prices in WA again. And so we're through that cycle. What happens from here is, yes, you're building a significant undersupply of housing. House prices in WA, we spoke in November last year and I said they'll go up 30% over the course of 3 years, and you've just about clocked that 30% up within 9 months. And so, we see house price growth slow. It's not going to continue at that pace just because households can't bear it. And so what happens...
So the limiter is affordability, not supply.
That's right. So work from home spaces suddenly become bedrooms that people are renting out to help cover the rent or pay for the mortgage. And so we see an increase in density. We get a slowing in that price growth. It may be stable for 6 to 9 months, but that's a fairly short time cycle.
So an ebb and flow situation of people readjusting until...
That's right.
Interest rates change.
Yeah, and we get that normal cycle that we see in other markets where house prices go through a cycle of rapid price growth, they stabilise for a period of time, and then they increase again. WA is not accustomed to that cycle. You will discover it happening because your house prices are so far below what your comparative market should be, and we'll say Brisbane is the comparable market.
I'm sure you remember Sydney, for example, in that 2014 to 2020 period, where nearly every year people were betting against Sydney, going, well, it's been 2 years, they'll have to break, or it's been 4 years, it'll have to drop. And every year it kept going up. Can you quickly talk to the context of that? Because I always talk to Sydney as being essentially Perth's future. 20 years ahead of us in many ways. The fundamentals of population, of culture and everything are really no different. We're all Australians.
Yeah. So the precursor to that was Bob Carr saying Sydney is full. It took a couple of years from that where constraints, particularly on greenfield land supply, were imposed. We saw increased taxes, developer charges, fees, levies, call them what you will. We're now in a situation 50% of the cost of a house and land package in Western Sydney is taxes, fees and charges. Just prior to the pandemic, a house and land package in Western Sydney was around 900,000. Now it's 1.5. So it's 600,000 up in 4 years compared to Western Australia, where you're probably looking at it being at most half that increase. Cost of building a house in Western Sydney is very similar to the cost of building a house in Perth. And so, that
income's slightly higher in Perth.
Yes. And so this cycle that saw Sydney prices rise, there was a constraint on supply. And all of the efforts to describe what was happening to affordability were ignored through that cycle because the obvious consequences of it weren't apparent. And what we saw at the start of the pandemic was that suddenly people wanted more space. They were at home more often. They wanted work from home space. They wanted larger bedrooms, larger study. And the same thing happened globally. As a consequence, we needed more homes for the population we had in 2020. And that cascaded very quickly. And now we're in a scenario where on top of that we have strong population growth. And the last bit that people always forget about is that demand for housing increases as we get wealthier. If we look at Japan as a great example, 30 years, zero economic growth, 30 years of declining population, they build 1 million homes per year. The same is true in Australia. If we have zero population growth and zero economic growth, we need to build around about 120,000 homes per year. For every bit of population growth or wealth growth that we have on top of that, that is additional housing demand. And so the government's 1.2 million, 250,000.
That's a baseline.
Yeah, that's right. It's 250,000 homes per year. It's not conceivable at this stage. There's going to need to be substantial policy reforms to achieve that goal. But at the very least, we need to get to that rate of build in order to eventually build enough homes to see house prices, and everyone's got different definitions of what the goal is, but to me the goal is a rental vacancy of between 3 and 5%, because that is the point at which landlords are chasing tenants, or landlords have to be good landlords.
Have to meet the market.
Yes, to service their renters, to attract them.
So I see parallels here with what you're talking about with where West Australia is at. You talk about supply being choked, especially in the house and land space, or just generally, right? Well, supply is choked in Western Australia. And it might have been from a planning and tax point of view in Sydney. It's a people point of view here. There is still planning chokeholds. There are still tax cost of build chokeholds. Those things have always been there. But really the thing that's changed in WA, where it's not meeting a general free market model, is we don't have the people to do the supply. Right. And in the same way, Perth is full in a way, right? We don't have the houses for the people too. So,
chicken and egg problem.
Yeah. So, and then you look at Sydney as a test case again. Again, slightly lower incomes, same sort of homes, same interest rates, your percentage of disposable income that's going towards your mortgage is 55%. It's been there for a few years now. And despite the fact that that starts to be a buckling point in the household, the dynamic between demand and supply continues to keep price growth at least above zero, even though it should really be buckling under itself, because you're still in a state of undersupply. Nowhere near the undersupply we have in WA, but the differential there being West Australia's percentage of disposable income spent on our mortgage is more like 35%, not 55%. And that is why I continue to talk to the point that regardless of whether a few hundred jobs were lost in the lithium industry recently or that project isn't going ahead and it was going to, we still are in that housing reality of being nowhere near solving that problem simply for the people who live in this state in the first place.
Yeah, and I think you guys are forgetting about AUKUS too, as that is going to be enormous.
I don't think anyone's really spoken about AUKUS.
Really?
I don't think anyone understands it.
Well, that is a lot of money and that is a lot of capacity that needs to be built in order to deliver it. So when you've got 3 federal governments looking to build housing for military staff, a scheme that is a part of a global network of defence facilities, that is an open checkbook. For the industry here in Perth, it's going to be a challenge to be able to respond to that, not just in terms of land, but also in terms of home building. And quite how the industry adjusts here. The West Australian building industry is very vertically integrated in comparison to other parts.
As a small number of oligarchs that control Perth's housing supply, let's put it that way.
Fiercely competitive, very efficient, vertically integrated businesses. So market-centric here is very different from elsewhere. That yes, you have a couple of players that are very dominant forces within the market, but a very efficient industry as a consequence of that. And just quite how they're going to go about delivering the volume of housing needed there, because that is more than what most mining projects have offered over the past decade in terms of employment and housing.
And I think because it's defence, it's submarines, you talk multiple billions of dollars, you don't really know where that's going, how that affects the state. It's a few years away. It really hasn't become front of mind for West Australians yet. The irony of it is it's going down essentially in Kwinana, Rockingham, areas that historically have been seen as low socio-demographic, areas that have grown by about 80% in value in the last 5 years, mainly actually on the back of East Coast investors, East Coast buyers agents looking at it thinking, oh, Manly. And the Western Australian investors going, no thanks. The irony is a lot of people's properties have close to doubled in value in that space. That's not even considering the fact that they are the local neighbourhood for where AUKUS is going to be, and the planning reality that will be required to house all the people, as you said, that are going to be needed to build these things.
This is the Melbourne story that we saw in the 20 years prior to the pandemic, which is population growth led to infrastructure growth that led to housing demand, which led to population growth. And Perth is likely to be on that cycle, a far more consistent pattern than what we've seen. I heard the Premier of South Australia's a line the other day, which is where the people go, the capital flows, the jobs go, the people flow. And that is very much the cycle that we're going to see in WA.
Well, it's good to hear, I guess, because jobs is what everyone wants in Western Australia. And all of us remember what life was like between 2015 and 2019 in Perth. And I think there's that self-defeating prejudice that we need to get off our shoulders and really expand, have the gusto of a Queenslander, Brisbane sort of mindset to think of, hey, what can we be, not, hey, what did we used to be? When we think about comparing ourselves to other states, one thing that's happened recently in the media, our median house prices just ticked over that of Melbourne's for the first time since 2015. And it's come at a bit of a shock to West Australians to think, hang on, we're not as good as Melbourne. How's that possible? I thought Melbourne was a better place to be. The reality is it wasn't that long ago, only a decade ago, that we did have a higher median house price. In fact, for a long time we did. Now, the reality of why has a lot more to do with the makeup of housing type in Melbourne versus the makeup of housing type in Perth. About a third of properties there are apartments and units, about 15 to 16% in Perth are apartments and units. So obviously, cheaper style of housing, bringing Melbourne's median house price or keeping it lower than it would be in Perth. We're only building detached houses at the moment, so our median house price starting to shoot up a lot easier. But there is no reason why our median house price doesn't stay above Melbourne's indefinitely, is there?
Well, what's going on in Melbourne at the moment, you have to keep in context. It's not just what's happening in Perth in terms of prices. So there's two things happening. Yes, there is the large exodus we saw through the pandemic now. People in Melbourne can no longer sell a house in Melbourne and buy a nicer house in Queensland. That's gone. They're selling and downgrading if they're moving. So the exodus has stopped and Melbourne's likely to have net positive net interstate migration right at the moment. The second is just a little lesson to every government. Don't increase the taxes on housing. You will get less housing. And what we're seeing in Melbourne is really just a bit of distortion of the market. The additional tax on owning a second property in Victoria is causing some market confusion. We're seeing a lot of properties coming onto the market. Now, if anyone suggests that that means that's an increase in supply, they don't understand supply and demand, because if somebody is renting a property and they buy a property, that is not an increase in demand. It's the same population, the same number of houses.
Different subset.
That's right. So shifting houses out of short-term rental into long-term rental leads to a shortage of short-term rental, meaning higher prices for short-term rental, which sees it sucking back houses out of the long-term rental market, and you end up with the worst scenario of fewer homes being built
When
and
did
the same
government
population.
distortion actually ever make sense?
Yeah.
Tim?
So the situation in Melbourne is that we've probably got 12 months of noise in that market, just until these properties that have come onto the market clear. And it's not that the fundamentals have changed. The problem for it is that it is causing confusion in the market in Melbourne. It is causing people to delay the decision to build a new home, and therefore just further causing that trough that Melbourne's in at the moment to be a little deeper and a little longer than what it should be. So look,
going forward,
12 months' time, Melbourne's going to pick up. It's not also like the rest of the country. Things aren't broken. Things aren't fundamentally broken. It's going to take a lot more than a global pandemic to cause a correction to the Australian housing market.
the reality is every capital city is undersupplied, just
That's
none
it.
of them as much as Perth.
That's right, yeah. And Canberra's at the other extreme, 2.2% rental vacancies, build a lot of apartments.
Still nowhere near oversupplied.
No.
Not oversupplied at all.
No. Well, yeah, house prices there consistent with what they are in Sydney.
Tim Reardon, Chief Economist at HIA, mate, it's been a really insightful conversation. I love the context. I love the conversation about things that maybe the rest of us in WA aren't talking to each other about every day, but also just, I think, a little bit of a calm down, chill out pill for anyone who has been listening, writing in, having a chat on radio about what's going on in Perth right now. Probably just to summarise, if we were at 240 degrees in the oven, we dropped down to 238
That's
degrees
right.
for the rest of the year.
Yep.
It's still a situation that leads to burnt roast chicken at the end of the day. So it's still going to be many years, I think Tim's confirmed with us, until we actually know how to turn that dial back down to 180 and get a nice succulent roast at the end of the day that everyone can enjoy. In the meantime, there's only one way that prices can go, as long as we can afford it. And what we do know, if we make the most, we're paying the least. So there's still quite a gap there to go before we end up being Sydney, right?
That's right.
Tim, thanks for your time, mate. Enjoy the rest of your time in WA, and I look forward to seeing you again, catching up on another panel some point in the future.
All right, thank you, and I always look forward to a walk on Scarborough Beach every morning.
Cheers.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!